The last time the conditions that exist in the American economy right now were all present simultaneously, silver went up 700% in 14 months. Not 70%, not 170%, 700%. And the investors who captured that move were not the smartest people in the room. They were not the ones with Bloomberg terminals or prime brokerage accounts or seats on the exchange. They were the ones who understood a single mechanism that the majority of the investing public missed entirely. A mechanism that is operating again right now in April of 2026, in plain sight, in the middle of the most significant economic disruption the United States has experienced since the stagflation era of the 1970s. And almost no one watching financial television today is connecting the dots the way those investors connected them in 1979. This video is about silver. But before we talk about silver, we need to talk about what is actually happening to the American economy right now, because the silver opportunity does not exist in isolation. It exists because of the economic moment we are living through. And if you do not understand the moment, you cannot understand why the opportunity is as significant as it is. So let us start with the data. The real data, not the talking points, not the administration's framing, not the opposition's framing. The numbers. The GDP of the United States contracted in the first quarter of 2026. The Commerce Department confirmed it. Negative 0.3% annualized growth, the first contraction in years. Every mainstream economist who has looked at the underlying cause has reached the same conclusion. American businesses and consumers, anticipating the most sweeping tariff regime in modern American history, rushed to import goods before the duties took effect. That front-loading created a temporary surge in imports that subtracted directly from the GDP calculation. The sugar rush is over. What comes after a sugar rush is a crash. And the data that has followed that GDP print is not the data of an economy that is shaking off the effect and reaccelerating. It is the data of an economy that is digesting a structural change to its cost base and finding it deeply uncomfortable. The average effective tariff rate on United States imports has gone from roughly 2.5% 2 years ago to over 23% today. Read that again. The tax that American businesses pay when they import goods from the rest of the world, which means the cost that eventually flows through to every American consumer who buys anything that contains a component made outside the United States, which in 2026 means virtually everything, has increased by a factor of nearly 10. JP Morgan's chief global economist has stated publicly that the uncertainty shock alone from this tariff regime is enough to meaningfully damage business investment and hiring even before the actual cost increases flow through the supply chain. Goldman Sachs has raised its recession probability to 45% over the next 12 months. Morningstar has called the tariff hikes, in its own language, a self-inflicted economic catastrophe for the United States. Consumer confidence has not drifted lower in response to all of this. It has collapsed. The Conference Board places current American consumer sentiment at its lowest reading since the start of the COVID-19 pandemic. The proportion of American consumers who expect a recession in the next 12 months has risen to a 2-year high. Google searches for the word recession surged in early April to levels not seen since the spring of 2020. The American consumer, who is the engine of approximately 70% of U.S. economic activity, is scared. And scared consumers do not spend. And when consumers do not spend, the businesses that depend on their spending contract. And when those businesses contract, they hire less and eventually lay off. And the cycle that every recession in American history has followed begins to turn. Now, here is where silver enters the picture. And here's the specific mechanism I want you to understand, because this mechanism is the entire argument. This is the thing that the Bank of America private research that circulates among the firm's highest paying clients identifies as the central insight for navigating the current moment. This is the thing that the investors who made generational returns in 1979 and 1980 understood, and that the majority of their contemporaries did not. When the United States economy is in genuine distress, when recession risk is real and rising, when the Federal Reserve faces the impossible position of fighting inflation caused by tariffs while simultaneously preventing a recession caused by the same tariffs. And when the dollar is weakening under the weight of fiscal deficits and trade war uncertainty, and when consumer confidence is at pandemic lows, the Federal Reserve eventually pivots. It always pivots. It has pivoted in every single economic crisis of the last 40 years without exception. The only questions are the timing and the trigger. And when the Fed pivots, when it cuts rates and signals that its primary concern has shifted from fighting inflation to preventing economic collapse, a very specific set of assets moves, fast, violently, with returns that compress years of normal market performance into weeks or months. Silver is at the top of that list. It has been at the top of that list in every single Fed pivot cycle of the modern era. And I will show you precisely why, with the historical data right now. But first, I need to give you a number. the number that Bank of America, JP Morgan, and Goldman Sachs are all watching. With the same intensity that a cardiologist watches a patient's vitals in the hour before surgery, that number is 64, the gold to silver ratio, the number of ounces of silver required to purchase 1 ounce of gold. As of this week, that ratio is approximately 64, not 30, which is where it was at the peak of silver's last great bull run, not 17, where it collapsed to in January of 1980, 64, sitting at a level that, in every previous economic cycle of the past 50 years, where recession risk was this elevated and Fed pivot probability was this high, has resolved in the same direction. Silver closing the gap with gold, dramatically, quickly, with the kind of price appreciation that makes investors who are correctly positioned look like geniuses, and makes investors who are watching from the sidelines feel like they have been physically punched. Let me give you the history, because the history is not ancient context. The history is the blueprint. In 1979, the United States was living through a moment that rhymes powerfully with April 2026. Inflation was embedded and painful. Consumer confidence was at generational lows. The economy was being squeezed between energy price shocks and Federal Reserve policy uncertainty. The gold to silver ratio was elevated, sitting above 40, reflecting the same investor preference for gold over silver during the early stage of the crisis that we are seeing today. Silver was at approximately $6 an ounce. What followed over the next 14 months was the most violent precious metals repricing in the history of modern financial markets. Silver went from $6 to $49, a 700% move. Gold, that same period, returned approximately 300%. Silver did not merely keep pace with gold during that crisis. Silver more than doubled gold's return during the acceleration phase. The investors who understood the mechanism, who knew that silver lags gold in the early innings of a crisis and then catches up explosively when the monetary conditions shift, made returns that define their financial lives. In 2010 and 2011, the Federal Reserve was in the middle of its post-financial crisis quantitative easing cycle. Rates were at zero. The dollar was weakening. Deficit spending was at levels that made fiscal hawks genuinely alarmed. The gold to silver ratio stood above 60 at the start of that move. Silver ran from $18 to $49 in approximately 8 months, a 170% return. Again, silver dramatically outperformed gold during the acceleration phase. Again, the mechanism was identical: monetary easing, dollar weakness, a ratio that had been elevated for too long, snapping back toward its historical average. In 2020, the COVID crash pushed the gold to silver ratio to its highest level ever recorded, over 120. The Federal Reserve responded with the most aggressive monetary expansion in American history. Silver ran from $12 to $30 in less than 6 months, a 150% return. The mechanism, identical. The Fed pivots, the ratio collapses, silver outperforms. Now look at where we are today. The ratio at 64, Goldman Sachs at 45% recession probability, the Fed facing a stagflation trap where tariff-driven inflation and recession risk are simultaneously present, exactly the trap that historically has eventually forced the Fed to prioritize growth over inflation, exactly the environment that has preceded every major silver move of the last 50 years. The Citigroup research desk has stated publicly that silver could reach $150 an ounce within 3 months if the current momentum is sustained. TD Securities has a 2026 high target of $118. JP Morgan's Global Research projects an average silver price of $81 this year with a Q4 high of $85. These are not fringe predictions from precious metals enthusiasts. These are the published targets of the largest financial institutions in the world. The private research is considerably more aggressive than the public targets. And I want to explain why that gap exists, because understanding it is essential to understanding the opportunity. The reason institutional public targets are conservative relative to private analysis is straightforward. When Goldman Sachs publishes a public price target, it is publishing something it can defend to regulators, to compliance departments, to clients who might sue if the target is not reached. When Goldman's private wealth desk sends a note to a client who pays $50,000 a year for unfiltered analysis, the language is different. The conviction is different. The directional clarity is different. The private analysis on silver that is circulating among institutional clients right now does not talk about $85 or $100. It talks about the structural deficit in silver supply, the 5 consecutive years of demand exceeding mine production by 160 to 200 million ounces annually. The solar panel demand alone that is projected to triple silver consumption in the energy sector over the next decade. The AI data center build-out that has turned silver from a monetary metal into a critical industrial input with no available substitute at scale. Let me give you the industrial demand picture in full, because this is the part of the silver thesis that most retail investors underweight. And it is the part that makes the 2026 silver setup structurally different from every previous cycle. A single solar panel requires approximately 20 grams of silver. There is no substitute material that performs at the same level. The International Energy Agency projects that global solar installation requirements over the next decade will push silver demand from the photovoltaic sector alone to levels that would consume the entire current global mine supply several times over. Electric vehicles use silver in charging infrastructure, battery management systems, and circuit boards. The semiconductor industry, which is expanding at a pace driven by the AI infrastructure build-out that Microsoft, Amazon, Google, and Meta have committed hundreds of billions of dollars to, uses silver in quantities that grow every year as chip complexity increases. Every server rack in every data center being constructed right now contains silver. The AI revolution is not just a software story. It is a silver story. And the market has not fully priced that connection. The supply side of this equation is the part that keeps the institutional analysts most focused. Global silver mine supply has been essentially flat for a decade. The easy deposits were identified and mined long ago. A new primary silver mine takes 10 to 15 years from discovery to production. The pipeline of new supply that would be required to meet the industrial demand trajectory being driven by solar, EVs, semiconductors, and AI infrastructure simply does not exist. It cannot be created quickly, regardless of what the silver price does. This is a structural supply deficit that has been accumulating since 2021. The cumulative shortfall from 2021 through 2025 is estimated at nearly 800 million ounces. That deficit does not disappear when the economy slows. Industrial demand for silver and solar panels and semiconductors is not cyclical spending. It is infrastructure spending driven by energy transition targets that governments around the world have legislated into existence. It continues regardless of whether American consumer confidence is at pandemic lows or at record highs. The combination of that structural supply deficit with the monetary tailwinds of a Fed pivot cycle and the sentiment tailwinds of a ratio at 64 that historically reverts toward its long-term average of 55 creates the exact convergence that institutional money identified before every major silver move of the past 50 years. But I want to be precise about something. Because precision is the difference between understanding this thesis and acting on it correctly versus understanding it poorly and losing money in an asset that was pointed in the right direction. Silver is volatile. It is the most volatile major monetary metal. It falls faster than gold in a risk-off sell-off. It falls harder when institutions deleverage indiscriminately. The correction risk that Goldman has identified for the broader market does not spare silver during its acute phase. If you are going to position in silver for the move I am describing, you need to size that position with the knowledge that another 10 to 15% of downside is possible before the Fed pivot arrives and before the ratio begins its collapse toward the historical mean. The investors who captured the 700% move in 1979 were not the ones who bought at the exact bottom. They were the ones who bought at a reasonable entry, sized their position correctly, removed leverage, and held through the volatility that preceded the move. That is the first rule of this setup. And in part 2, I'm going to give you the complete framework. The specific vehicles that institutional money uses to gain silver exposure with different risk profiles. The 3 rules I have drawn from 4 decades of watching crisis investments play out that separate the investors who capture these moves from the investors who watch them happen from the sidelines. The warning signs that would invalidate this thesis and tell you the setup has failed. And the precise triggers to watch that will tell you the acceleration phase has begun. If you have watched this far, do one thing before part 2. Drop a comment below right now. Tell me where you are watching from. Tell me what city, what state, what part of America you are in, because the economic pain I have described in this video is not evenly distributed. It hits differently in a manufacturing town than it hits in a financial center. It hits differently if you are a small business owner absorbing tariff cost increases than if you are a salaried employee whose costs are rising but whose income is stable. And I want to know where the recession warnings audience is. I want to know who I'm talking to. Because this channel exists for every American who understands that the difference between the investors who build wealth during economic disruption and the investors who lose it is not intelligence. It is not connections. It is not access to a Bloomberg terminal. It is whether you understand the mechanism before the move happens. The economic disruption that is reshaping the American financial landscape in real time. The historical blueprint that shows what silver does in every Fed pivot cycle of the past 50 years. The structural supply deficit that makes this cycle different from every previous one, and the gold to silver ratio sitting at 64, elevated historically mean reverting, pointing in a direction that every major bank's private research is currently tracking with extraordinary attention. In part 2, I'm going to give you the practical framework, the specific vehicles, the rules, the risks, the triggers, and the honest assessment of what could go wrong, because any analyst who gives you only the bull case for any asset is not giving you analysis. They are giving you salesmanship. And salesmanship will not protect your capital when the volatility that precedes every major move in silver tests your conviction. Let us begin with the vehicles, because this is where the gap between what institutional clients are told and what cable television discusses is at its widest. The first and most straightforward vehicle is SLV, the iShares Silver Trust. It is the largest silver ETF by assets and by daily trading volume. It provides direct, liquid, frictionless exposure to the silver spot price. When silver moves up 20%, SLV moves up approximately 20%. When silver falls 15%, SLV falls approximately 15%. No storage costs, no counterparty complexity beyond the institution that manages the trust, no company-specific risk. For the investor whose thesis is purely a price-return thesis, who wants to participate in the silver move I have described without taking on the additional risk layers that come with other vehicles, SLV is the instrument. Understand what you own when you buy SLV. You own a financial claim on silver that is intermediated by a large institution. You do not hold the physical metal. In normal market conditions, that distinction is manageable, and the liquidity advantages of SLV over physical silver are significant. In a scenario where the financial system itself is under severe stress, the distinction matters more. Know which scenario you are investing for. Size your position accordingly. The second vehicle, and the one that the Bank of America Private Wealth Research spends the most time analyzing for its sophisticated clients, is the senior silver miners. Not the gold miners, not the diversified precious metals producers, the pure play silver companies. First Majestic Silver, Pan American Silver, Mag Silver. These companies provide what institutional analysts call leveraged beta to the silver price. And the mathematics of that leverage are worth understanding in detail because they are the reason institutional money, when it wants maximum upside in a silver bull market, does not simply buy SLV. Here's the math. When silver trades at $75 an ounce and a well-run silver miner has an all-in sustaining cost of $18 per ounce, that miner earns $57 of margin per ounce of silver it produces. When silver moves to $100 an ounce, with costs relatively fixed in the short term, that same miner earns $82 per ounce. Silver moved 33%. The miner's margin moved 44%. But the market does not price miners on margin per ounce alone. It prices them on a multiple of earnings and free cash flow. When those underlying numbers jump 44%, the stock price of a well-run miner in a bull silver market typically jumps 60 to 90%. The price of the underlying metal moved 33%. The stock moved somewhere between 60 and 90%. That is the leverage. That is why the senior miners are the vehicle of choice for institutional money that wants aggressive silver exposure with manageable liquidity. The risk of that leverage runs in both directions with equal force. If silver falls 20% from here, the senior miners fall 35 to 50%. This is not a vehicle for capital you cannot afford to hold through continued volatility. It is a vehicle for capital you can size correctly, position deliberately, and hold with the knowledge that the fundamental thesis remains intact through the drawdown. The third vehicle is SILJ, the Amplified Junior Silver Miners ETF. The juniors are the most volatile expression of this thesis. They are also historically the highest returning during the acceleration phase of a silver bull market. In 2010 and 2011, the junior silver miners as a group returned over 400% during silver's move from $18 to $49. They also fell over 70% in the correction that followed. CLJ is the vehicle for the investor who has the highest risk tolerance, the clearest conviction in the thesis, and the longest time horizon. It is not the vehicle for money you cannot afford to hold at a 40% loss on the way to a 400% gain. Sizing matters more with SILJ than with any other silver vehicle. A 2 to 5% portfolio allocation that you can hold through maximum volatility will serve you better than a 15% allocation that forces you to sell at the worst possible moment because the drawdown became emotionally intolerable. The fourth vehicle is physical silver. Coins, bars, allocated accounts held outside the banking system. I want to address this directly and without the dismissiveness that financial media typically applies to physical precious metals ownership, because that dismissiveness is itself a tell. It is the tell of analysts who are speaking to clients who have enough wealth that financial system stability can be assumed. JP Morgan holds physical precious metals in institutional client portfolios. Goldman Sachs advises its highest net worth clients on physical allocation as part of a complete portfolio construction. The question of whether to hold physical silver is not a question about paranoia or conspiracy theory. It is a question about which risks you're most concerned about and which vehicles are most appropriate for hedging those specific risks. If your primary thesis is a price return thesis, SLV or the miners are more capital efficient. If your thesis includes a scenario in which the financial disruption caused by the current tariff regime the fiscal deficit trajectory, and the Federal Reserve's policy constraints produces stress in the financial system severe enough to impair paper claims on metals. Physical silver, held outside the banking system, is the expression of that thesis. Both theses can be simultaneously valid. Both positions can exist in the same portfolio at different sizes. Now, let me give you the 3 rules that I believe separate the investors who capture silver moves from the investors who watch them happen. The first rule is the one that is most frequently violated and the one whose violation is most costly. Do not buy what is already spiked. Silver at $30 in January 2025 was the entry that produced 147% returns by December. The investors who bought silver in late December 2025, chasing those returns, bought at the high of the first move. Silver has since pulled back toward $75, which feels to the investor sitting inside the correction like a failed trade. It is not a failed trade. It is the setup for the second move. The investors who bought at $30 because they understood the mechanism before the price reflected it made 147%. The investors who buy at $75 because they understand the mechanism that drives the second move, the Fed pivot move, the ratio mean reversion move, the structural deficit recognition move, are positioned for a return that the historical data suggests will be substantial even from today's levels. The first move belonged to the investors who saw the structural thesis before the crowd. The second move belongs to the investors who understand the macro cycle that the first move did not fully price. The second rule is the one that most consistently separates institutional thinking from retail thinking. Follow the money, not the headlines. The headline of this moment, the thing that cable television discusses with breathless urgency every single day, is the tariff war, the uncertainty, the recession fear, the GDP contraction. These headlines are real. They describe real conditions that are causing real pain for real American families. But they are not the signal. They are the noise that the signal is buried inside of. The signal is the Federal Reserve's trajectory. The signal is the bond market's behavior. The signal is the gold to silver ratio. The signal is the 5-year structural supply deficit in silver that the tariff headlines completely obscure. When those signals align, when the Fed begins cutting, when the ratio begins collapsing toward its historical mean, when the industrial demand numbers confirm that the deficit is deepening rather than resolving, the price move that follows is not driven by the retail investors who finally understand the headlines. It is driven by the institutional reallocation that has been building in the private research and private portfolios for months before the public narrative catches up. You are reading the private research right now, not because you pay $50,000 a year for a private banking relationship, because this is recession warnings, and this is what we do here. The third rule is the least glamorous and the most necessary. Remove leverage before you do anything else. Goldman Sachs has identified meaningful additional downside risk for the broader market if the current economic uncertainty deepens. The same volatility that will eventually produce the silver move I have described will, in its acute phase, push silver lower before it pushes it higher. If you are leveraged when that acute phase arrives, the leverage will force you out of your position at precisely the worst possible moment. The moment of maximum fear, the moment that in every historical analog has been the entry point for the investors who made generational returns. The investors who made 700% in 1979 did not do it with margin accounts. They did it with capital they could hold. Remove leverage first. Position in the beaten down assets with the intact structural cases second. Wait for the pivot third. That sequence, in that order, is the institutional playbook. It has worked in every major precious metal cycle of the last 50 years. There is no reason grounded in history or current fundamentals to believe this cycle will be different. Now let me give you the honest risk assessment. Because the bull case for silver is compelling. The historical evidence is unambiguous. The institutional research supports it. And none of that changes the fact that this thesis can be wrong. And if you are going to put capital at risk, you deserve to know specifically how it can be wrong. The primary risk to this thesis is stagflation, not recession. Stagflation. The scenario where the tariff regime keeps inflation elevated at the same time that growth is slowing, forcing the Federal Reserve to keep rates higher than it otherwise would in order to prevent inflation expectations from becoming embedded. In a genuine stagflation scenario, the Fed does not pivot cleanly toward easing. It sits in a policy trap where cutting rates risks reigniting inflation and keeping rates high risks deepening the recession. Stagflation is the scenario that delayed the full silver bull market in the early 1980s, even after Volcker's tightening had already begun. It is the scenario that the Deutsche Bank research team has identified as the most dangerous outcome of the current tariff environment. If U.S. inflation remains stuck above 3.5% while GDP continues to contract, the Fed pivot that drives the silver move I have described may be slower and shallower than the historical analogs suggest. The second risk is dollar strength. Silver is priced in dollars. A strengthening dollar reduces silver's purchasing power in the global market and typically suppresses silver demand from the non-US buyers who represent a significant portion of the global silver market. The tariff regime has created cross-currents in the dollar. On one hand, trade war uncertainty and recession risk typically weaken the dollar as capital flows to other safe havens. On the other hand, if the US avoids recession while other major economies struggle, the dollar can strengthen even in an environment of elevated uncertainty. Watch the dollar index. A sustained move above 105 in the DXY is the indicator that would most meaningfully challenge the near-term silver thesis. The third risk is the one that no analyst likes to discuss because it is genuinely unpredictable. Policy reversal. The Trump administration has demonstrated willingness to change course on tariff policy when market and political pressure become sufficient. The administration retreated from the most extreme Liberation Day tariffs. It has rolled back specific duties when the economic damage became politically inconvenient. If the Supreme Court rules against the administration's authority to impose tariffs under the International Economic Emergency Powers Act, which the Stanford Institute for Economic Policy Research expects to happen, a significant portion of the tariff regime could be unwound rapidly. A tariff rollback would reduce the recession probability, reduce the Fed pivot probability, and reduce some of the safe haven demand that is currently supporting silver. It would not eliminate the structural industrial demand thesis. It would not close the supply deficit. But it would remove a significant macro tailwind from the near-term price argument. Know these risks, size your position to reflect them, and watch 3 specific triggers that will tell you the move has begun. The first trigger is Federal Reserve language. When the Fed begins shifting its public communication from inflation concern to growth concern, when the language in the FOMC statement moves from caution about price pressures to concern about labor market softening, the institutional reallocation into silver and silver miners begins accelerating. You will not hear this shift announced. You will read it in the word choice of the statement. You will see it in the bond market's reaction within hours of the release. The second trigger is the gold to silver ratio. When the ratio moves decisively below 60, it is confirming that the institutional reallocation is underway. Not retail buying, institutional reallocation, the kind that moves markets. A sustained move below 60 in the ratio is the technical confirmation of the fundamental thesis. The acceleration phase, historically, begins when the ratio breaks below 55. The third trigger is the silver ETF inflows. The iShares SLV Trust publishes its holdings daily. When institutional money is building silver exposure in size, those holdings grow in ways that are visible to anyone who tracks them. In 2020, the SLV holdings surged from 11,000 tons to over 17,000 tons in a period of weeks preceded and then confirmed the silver price move from $12 to $30. Watch the holdings. When they begin moving in the direction that suggests institutional accumulation rather than retail speculation, the setup is transitioning from preparation to execution. The investors who will look back on April 2026 as the moment that changed their financial trajectory are not waiting for the confirmation. They are not waiting for the headline that says, the Fed has cut, silver has broken $100, the ratio has collapsed to 40, and everyone on television is talking about the silver bull market that has arrived. Those investors will read about the returns that were available in April 2026 long after the window to capture them is closed. The setup is not complicated. It is not hidden. It is sitting in the ratio, in the structural deficit data, in the Federal Reserve's trajectory, in the institutional research that the largest banks in the world are circulating among the clients who pay the most for honest analysis. The mechanism is the same mechanism it has been in every major silver move of the last 50 years. The Fed is being forced toward a pivot. The ratio is elevated and historically mean reverting. The structural deficit is deepening. The industrial demand is structural, not cyclical, and not reversible by tariff policy or recession fears or any of the headlines that are dominating the financial news cycle right now. That is the silver setup. That is why it is happening right now. That is why 95% of the investors watching the same headlines you are watching every day will miss it entirely. Drop a comment right now. Tell me where you're watching from. Tell me whether you are already positioned or whether this is the first time this thesis has been laid out for you with this level of detail. Because that conversation between the people who watch recession warnings and actually think at this depth about what the markets are doing and why is one of the most valuable things that happens on this channel. The people who comment here are not passive spectators. They are the investors who want to understand the mechanism, not just the headline. And if this is your first recession warnings video, hit subscribe. Because this is the level at which we talk about markets here, every single time.